Yeah, I think very much so. It's shifted absolutely back to non-discretionary to absolutely required elements of our lives. So this is food, this is medicine, the absolute basics. Now, these are our customers. Now, in addition, you also have energy, as you were talking about earlier, Karen. You've got a drop in consumption of energy, increased demand, and so that causes the oil price to fluctuate. But it's looking in the future is that oil price doubles by the time we get to the end of the year. So for our customers, it's about certainty. As they find it more difficult to get spare parts and they look to drive more efficiency in a downturn, in a negative economy, we provide the software to help them improve their businesses and free up cash.
So how different is it in this crisis with companies using tools that you're providing with digital disruption? And many companies, of course, have had to invest in recent years. So how different is it for companies going into this crisis, say, versus the global financial crisis about 10 or so years ago?
Well, if you think of financial services, it's already heavily digital. Almost everything in financial services is digital. But the industrial sector, which is where we serve, it's very little of it is digital as of today. A lot of it is break and failures occurring, repair of facilities, the design of facilities is not optimized. So by putting more digital into those manufacturing facilities, but mostly process industries, you can take a lot of operational cost out, and you can have more certainty when you manufacture a new facility. Now, our customers had hired chief digital officers and CTOs to drive a digital transformation. But COVID-19 and the shift in the world in the last 90 days is dramatically accelerating their digital agendas.
Craig, it's like Back to the Future. It's like the conversation you and I had at ADIPEC 2 years ago about digitalisation in the energy industry. So, look, I've always understood the structural story. You've said it very graphically as well, but the cyclical story for your energy and industrial company clients and customers as well. How tough is it for them at the moment? How much pressure are they putting on you to reduce your costs or indeed cancelling orders?
Yeah, I mean, for our business, about 10% of our business is what we call greenfield CapEx, which would be the build out of a new facility, a new refinery, a new offshore platform. And those projects typically run for several years. And so our customers, they buy the software under what's known as a subscription. So they subscribe to it for the life of the product. So what's happened, Steve, is that customers who had very little interest in running those engineering design seats in the cloud, of course, with remote workers, everyone working from home, now very much want that to be in the cloud. And so we've made it available for no charge to our customers the ability to run all that engineering design work running up in our cloud. Now, longer term, as we see a reduction in CapEx, there's no doubt that there will be pricing pressure. But let's just put this in perspective. This is an industry that was spending $250 billion a year in CapEx in the build out of new facilities. A 30 or 40% reduction in that number is still a very large amount of CapEx spent, and very little of it is digital.
But Craig, we look at the devastating position that shale was in even before coronavirus as well. And I look today at the front month, May, WTI trading in the mid to high teens as well. These are kind of levels that we'll see basically just ripping up of plans for the future of the trillions of dollars that the likes of Fatih Birol says need spending as well. That must be very worrying for the broader, not only the energy complex, but across the rest of your business.
Yeah, I mean, that's a very good point, Steve, on shale. So, shale is a relatively simple production method. Roughly you invest pretty heavily, and then you extract the material for 18 to 24 months after the fact. You have all of the capital spent in the build out of that field upfront, and then you pay off your debt over the period of time. Now, below $30 a barrel, shale is not not functional. It doesn't work, and so that's where you see a lot of defaults in it. Now, for better or for worse, that's really not an industry that we focus on. It's relatively simple to construct those facilities. Our customers, they're building large refineries or chemical facilities to produce nylon or poly products that we use in healthcare, for example. But to your point. Pricing pressure, the price of oil dropped to $15 a barrel. That puts pressure on our customers to free up spend. So no doubt they're knocking on our door and they're asking for ways to free up money, which is not so subtly. Could you reduce your prices and your contracts, Craig? Well, there's other ways that we can help them free up cash, quite frankly. For example, we can optimize their supply chain. We can free up $1 a barrel just by using digital optimization across the supply chain. And so those conversations are the ones that have become much more, I'll say, frequent now with our customers in the last 90 days.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.